Welcome back, everybody, to the Investors Roundtable. I'm your host, Robert Kraft. You can follow me on Twitter at Bobby K. Kraft. That's BOBBYKKRAFT. And we got an episode for you today. I feel like every financial content creator right now is probably doing an episode on the Berkshire Letter, and I'm so unoriginal that we're going to do the same. So joining me right now is a frequent guest of the show, friends of the family now. We got Stephen Kiel from Arquitos Capital and Matthew Peterson from Peterson Capital Management. What's up, fellas?
Hey, guys. Yeah, great to see you guys.
Yep, good to be here. Thanks, Bobby.
Now, before we get into it, this is my first time talking to Matt since my epic trip to Austin. Matt's based in Austin, and we actually got to see, we did a socially distanced hang and, walked the frozen tundra lake a little bit. And Austin's so cool. It's such a cool city, but damn, talk about timing, huh?
Yeah, that was an interesting event, wasn't it? I mean, it was like truly a natural disaster, and you were here for it. So we had the coldest temperatures in I don't know how long, and apparently we haven't seen snow like that in 60 years. So yeah, we were one of the lucky ones. We kept our power. We lost water for 5 days,
wow.
But we managed through just like everyone else. So things are back to normal. It's about 72 and sunny today.
72 and sunny. You hear that? I think that's nicer weather than where Steven is right now in Puerto Rico.
Yeah, the 72 is good. I'm in Puerto Rico. It's a little bit humid here. And do you have roosters crowing in the background in Austin, Matt? That's what I have going on.
They're not in my current background, but they're around. So
yeah.
Wait, no, Steven, you got to show you were saying there's a horse across the street.
Yeah, he walked away now, though. I don't know. I'm gonna have to wait till he walks back. But I'm in the west side of the island right now. I was in Old San Juan and Condado for a few weeks, and came over to the west side a couple of days ago. And it's a little more rustic here, a little more humid. Beaches
is that like the Ponce? Nice. Is it called Ponce, Steve?
Or yeah, Isabella, Rincon area.
Oh, there's good surf there.
Beautiful.
There is.
Man. I gotta make it to that part of it. Yeah, because listen, I only asked because at some point I really would love to get a comment from the horse on the Berkshire Letter.
Yeah, he's looking over there. He got shy, I think. He walked away. He wasn't happy with the letter, I think was the point. He was disappointed, that Buffett has. Some people have accused him of losing his fastball here, and the horse is hiding in shame. It seems like.
Look, if Buffett has lost his fastball, I think he's like the Jamie Moyer then of baseball, where like it doesn't matter. He can still he's still very, very effective.
Yeah, absolutely. Yeah, I mean, so to get into it, that is, I read some of the commentary here about, so there was some disappointment. That Bloomberg article I thought was ridiculous, where they basically, said, well, he hasn't made any comments about the pandemic and it was a tone-deaf letter. Well, you write the letter. You can say whatever the hell you want. You're the one who's in charge, right? And to get kind of stuff thrown at you from the peanut gallery was, I thought, a little bit unfair. And I thought that article was unfair. Other commentary I saw, was speaking of, that idea of him losing his fastball. But, to your point, Bobby, I mean, he is, Jamie Moyer is the Warren Buffett of baseball. Maybe they'd say that. And
I probably Nolan Ryan. Nolan Ryan was,
sure.
I think, or something like that. But no, Bill sure. Brewster. I can't remember if it was Bill or Jake or Toby that said it on Value After Hours. They're like, I mean, look, you're gonna Warren Buffett at 90. He's probably way sharper than any of us would be in our like peak of our primes. So chill.
Well, yeah, and I think the idea and the feedback is, look, they haven't had any luck making major acquisitions. The idea of kind of selling all of the airlines and everything coming out of the pandemic, maybe not fully appreciating the power that the Fed, the Fed actions caused such a dramatic V-shaped stock market recovery, which I don't think any of us, quite frankly, anticipated. But, he, I guess there's a fear of missing out kind of thing from some of the commentary that Buffett, used the opportunity to buy back stock, which was great during that time period, but did not really make any new major investments.
Yeah, I think, Steve, I echo everything you're saying. And I've, read all of the commentary about the letter. And there do seem to be a lot of sort of complaints coming from the peanut gallery, which I think is interesting. He's been writing these letters for so long. It's hard to come up with quality new content. But I think one of the most overlooked aspects of this all is that they're buying back 25 billion in stock. And they're buying back 25 billion over basically mostly in the last few quarters. So they are accumulating a massive amount of their shares. And that's going to have, and basically everyone's looking at their 13F. They're seeing they're like buying back, buying into Chevron, buying into Verizon. But actually the cash buybacks of Berkshire Hathaway dwarf all of these other purchases. And they're just not recognized as much. I mean, it is a big impact to buy back 5% of your shares in a year.
Absolutely. I mean, what's some of your thoughts as to why they wanted to do that? You know, is it? I'm sure you have some ideas on that.
I mean, the fundamentals are so strong, and this has been a core holding of ours for years. And I know it's not some sexy position, right? They're not launching rockets and racing cars and things, so it kind of gets lost among all the meme stocks. But you know, the fundamentals are the fundamental value of the business is so large. In fact, I went through in our own annual letter that I released, I think, a week ago, and sort of wrote out the different components, broke it down like super simplified. And it's quite amazing. It's like they have, I believe, and correct me if the numbers are off, but it's like 135 billion in cash, right? And they have somewhere around, I don't know, like 240 billion in stock. And then they basically have this operating portfolio, their operating businesses. And if you subtract sort of cash and stock from the market cap of like 550 or so, you're basically going to be left with just a couple $100 billion for all their operating companies. And one of the surprising things that I also didn't see people pick out of the letter is that he compared the value of Burlington Northern to the value of Apple. And the Apple value is like 110 billion. And he basically said it's a toss up between the two. We don't know which one's going to be more valuable. Is it our Apple shares or is it Burlington Northern? Now, Burlington Northern is one of about 100 subsidiaries that they own, right? So everybody watching is going to already know that they own, you know, Geico and all their insurance businesses and their energy, you know, businesses. They also have NetJets and Fruit of the Loom and everything else under the sun, Justin Boots. It's massive. Dairy Queen and Duracell. I mean, you can keep going. So they own all these subsidiaries. Burlington Northern is 110 billion based on what Buffett wrote. And they only have 200 billion affiliated with all of the operating companies. That leaves $90 billion for the other 99 that they've accumulated over the last 60 years. That is just unfathomable. These operating businesses are earning like, I think it's around 22, approaching 25 billion per year in operating income. So throw that Burlington Northern back in, you have $200 billion to buy all these operating companies that are earning 25 billion. So you're getting basically, you know, maybe an 8 times earnings for Buffett businesses, which is just unbelievably inexpensive. It is such a steal. So of course, it doesn't surprise me that Buffett's taking as much capital as he possibly can and buying back his own stock because it's the cheapest company and cheapest opportunity that they have.
Yeah, and the interesting part too to that is, and I guess that's where some of the negative commentary has come in, is why wasn't he more active in the end of Q1 and Q2? He became very active in Q3 and Q4. And, you know, I think Buffett doesn't generally call the bottom. And if you remember back in 08, 09, when he wrote that op-ed about, you know, about getting active in the market, that was the fall of 08. The bottom didn't occur until March of 09, 6 months later. And so, you know, he's never said he's been good at, I mean, if you call the bottom, you're lucky essentially here. And it was fair for him and Berkshire to be uncertain during that time period with all of the information on the economy that he was seeing through the operating businesses and his conversations there, and the insurance exposure. You know, and when you think about early Q2 and before the annual meeting, where he was very cautious in the annual meeting, you know, that's the reason why they were not more active at that time of the year. Now, once he got more certainty, especially in the insurance side, that's when they started ramping it up. And I mean, I think Charlie Munger's hands were all over that. I think they're looking at the alternatives, and there's no really major acquisition opportunity out there because these companies that they potentially could have acquired are all significantly overvalued on a historical basis, given the conditions of the overall economy. And so the next best option out there is Berkshire itself, as you indicated, Matt. I mean, it's very cheap by almost any metric.
Mm-hmm. Yeah. And I do think, they were sort of getting prepared for some distressed lending, maybe following the same protocols that they implemented in 2008 and 9, where they were able to get quite almost onerous interest rates and payments from high quality firms. And the Fed sort of stepped in and took that all away from them. So, all of the stimulus and all of the lending made it very difficult to become that lender of last resort like Berkshire likes to be.
Yeah, I mean, that's the competition. The Fed crowded them out.
Mm-hmm.
And that's the competition for the type of stuff that he did in 08, 09 that he was unable to do now. And so, I think, again, I don't want to spend the whole time talking about kind of the criticisms and attempting to rebut them, but, the lack of activity there was frustrating. And I'm sure it was frustrating for him as well. But look, putting $25 billion to work, and it seems like, it's been ramped up even more in Q1 here this year, that's a significant acquisition in and of itself of Berkshire stock. And there's still plenty of liquidity to go make a major transaction if something comes up. There's still significant liquidity to make big passive investment stakes. And the operating companies are still chugging along very well, as you indicated. And there's great reinvestment opportunity in them, both with Burlington Northern and with the energy business. These are two massive businesses that if they were standalone would command much higher valuations than the credit they're getting within the Berkshire portfolio.
Yeah, Steve, what's an interesting soundbite? I heard from a friend yesterday, and I haven't verified this stat, but they did a deep analysis of the volume over the year and figured out that Berkshire, if for them to accumulate 25 billion, it required them to be almost maximizing their capability of purchasing and buybacks. So if they're doing it all through the public markets, they're buying back. It appears that they might be buying back as much as they possibly can.
Yeah, I think that's the case because people don't appreciate the different blackout time periods, liquidity, volume requirements in the buybacks. And, I'm involved in a small public company, and I was unaware previous to that involvement, all of the limitations that we have with those types of items, whether buybacks or other transactions and things like that, the blackout periods. And so, I would agree with that. I think they're as active as they can be, aggressively doing everything they can to shrink the share count. And, people who are not kind of traditional value investors don't appreciate that. Mm-hmm. But if you treat that as a set aside and say, look, he's buying $25 billion worth of a company at 8x cash flow, you'd be happy about that.
It's amazing. That's right.
Hey, let me ask you guys a question. He in the letter, he specifically had one section talking about, conglomerates and how Berkshire has been often labeled as a conglomerate. Why do you think what do you think was his purpose in bringing this up right now, considering the kind of year 2020 was? Anyway.
Yeah, that's a good question. Look, I think there's a stigma with a conglomerate, and there's always this known sort of conglomerate discount. And he sort of, I think, wants to address that in that section and sort of, I sort of indicated that although they are considered a conglomerate, they're a very different type of conglomerate. And this is sort of a masterpiece that they've built over decades. And it's quite powerful the way that they've structured it.
Yeah. And compared to, I think, look, you have to, for the record books here, for posterity, it's necessary to have this description to show how it really was different than a Henry Singleton style of conglomerate. That's what he's referring to without calling his name out, you know, where you bid up the stock price and then you buy something that's also overvalued, but a little less overvalued than your own stock, right? Now, Singleton, of course, who he respected a great deal, would do every angle of it, because he would do that. The stock price is overvalued. He would buy something with stock a little bit less undervalued. And then, you know, it would become undervalued. He would buy back shares, you know? So that was what made Singleton unique in that case. But most conglomerates who run that model don't do the buyback share part. You know, they take their overvalued stock and they use it to buy another overvalued company, and they're creating value financially in that in the short term, but not in the long term. And it's not creating real economic value. And, you know, I think it was important for Buffett to point that out. I don't know that he has done it as succinctly or as clearly in previous letters that I can recall, although he has talked about it before. So, you know, I think it was a valuable thing to put out there for future readers to understand how Berkshire's different than that.
Gotcha. So what would you guys say was your number one take? I mean, you guys have kind of given already a couple takes here, but what would you say is your number one takeaway from this letter, and how does that make you think about then 2021 moving forward, just in general?
Yeah, Bobby, that's a great question. You want to go ahead, Steve?
No, go ahead, Matt. Yeah.
So I sort of already alluded to this, but one of the key things that I found just valuable in general was that he compared Burlington Northern's value to Apple, because it put a price on one of the operating companies that you can then remove from the remaining bundle and price and look at, and it just becomes so clear that things are totally undervalued and underappreciated. So I thought that was really, really helpful. I also thought it was unique and interesting how he sort of documented the different types of shareholders that own Berkshire Hathaway, and sort of laid out this, sort of talked about how they still look at themselves after all these years as a partnership. They still really care about the single investor who owns a few B shares and is sort of letting, Warren and Charlie manage their capital. And so there was a couple of really actually unique aspects to this letter that we haven't seen in other letters.
Yeah, so I've got a helicopter flying over right now, so you might hear that noise a little bit in the background. So I'll take a little bit of a pause here. You know, we got roosters, we got helicopters, we've got Ed the horse over here as well, who's still hiding. But you know, to that point, the comments about Apple buying back shares and the value there was also an interesting aspect, talking about Berkshire buying back shares and then Apple as well. And clearly he thinks Apple's buying it back at reasonable valuations because he endorsed it, right? So that's interesting. To me, the biggest takeaway, and you know, this isn't the deepest thing in the world, but it's exciting that we're going to have Charlie back on the stage at the annual meeting, and Buffett's traveling out there. And it's a little bit interesting. You know, we had Greg Abel on the stage last year, and he said, you know, Abel and Jane will be available for questions, but it's going back, it sounds like, to a little more traditional annual meeting with Charlie and Warren. And I found it interesting that over the last 5 to 7 years, they've been not very willing to open up the stage more to Ted and Todd and to Greg Abel and Ajit, that it still is at age 97 and 91. It still is Warren and Charlie there for 6 hours.
Yeah. You know, I don't know, Bobby, I don't know if your viewers sort of listen to these things for I guess, financial recommendations. And I guess this isn't really a recommendation, but I think people in general are sort of missing the significance of this opportunity. There are so many investors who would do extraordinarily well by owning more Berkshire Hathaway. Warren Buffett himself is taking a huge amount of his cash pile and dumping $25 billion into Berkshire Hathaway. And if you look at the map that I just laid out, where it's like made up of cash, stock, and their operating companies, and you recognize you're able to buy Warren Buffett's hand-selected securities for 8 times cash flow. It's just absolutely remarkable. And it doesn't take very much thought. You could literally put your entire portfolio, I think, into Berkshire Hathaway and probably do very well, most likely outperform the market and most likely outperform most professional investors. It's just an absolutely amazing situation. And along with that, there is, I'll actually add two quick comments that there is a massive floor to this price because it's trading so low and it has these hard liquid assets. It's like there's asymmetry in the risk reward here. So it's really not going to be a lot cheaper. They could just screw up everything and never invest another penny, and it's probably going to increase significantly in price. There's a solid floor. And on the upside, things can go pretty parabolic. It's not going to be your Tesla. It's not going to have volatility like Bitcoin. But, I think you can get some very nice teens returns for a decade and with a very muted downside. And it's just that sort of thing in this sort of environment and with this level of safety is really rare, really uncommon. It's a huge opportunity for everybody.
I mean, come on, you don't think Buffett wants to be a meme stock? I mean, you think part of him maybe at some point is just like, I want to be on the rocket. I want to be on the, I mean,
I think if he buys Robinhood, that would be, then we know he's lost it, right?
Yeah. That would be pretty amazing. Wow. Oh my gosh. That might be like the biggest financial news story probably in the last like 10 years.
But, I think we're in a situation where it is a little bit like the late 90s where everybody thought he was out of touch, given in the environment, and that those accusations are coming again. And, I think in a couple of years, we'll see just how right he was. When we do get some market corrections from some of those meme stocks, and Berkshire's still there chugging along, buying back shares at cheap valuations that now then allow, when the tide turns in terms of valuations for a company like Berkshire, those buybacks are going to be seen as even more valuable.
Absolutely. Now, look, just speaking from experience, having had to make the long drive from Austin to Albuquerque, being a native Californian, and barely ever seeing a Dairy Queen, I saw more Dairy Queens per capita than I think I ever have in my life. But yeah, that's
got to come to the flyover states. That's right.
That's where those Dairy Queens are. We almost stopped to get a burger, but we actually stopped at Sonic because that you don't see anywhere in California, or at least I don't know where we are. And that is actually pretty good. I did enjoy it.
Yeah, I mean, look, the ice cream when I was a kid, and they came out with the Flurry or whatever it was called. That was a big deal for about 5 to 7 years, and so we do have to appreciate the reach that some of these brands have, including Dairy Queen. Oh, yeah. So it is what it is, and these things keep getting valuable, especially the See's candies and things like that. But those are small potatoes, as Matt mentioned, relative to Burlington Northern and the energy company.
So let's have a little
energy.
Yeah. So let's have a little fun here. So, as you said, look, they have a major cash pile right now. You're kind of joking about how, we think he would lose it if he went and bought Robinhood. But what would be kind of the most Buffett buy right now that would be that's currently out there? I'm sure you guys have thought about this.
Well, I think it'd be something overseas, quite frankly, some sort of utility company or some sort of infrastructure type play overseas. I could see something in Eastern Europe or something along those lines. But it looks like a tough environment here in the U.S. for any major acquisition, especially given what's going on in the SPAC world.
I was just going to say.
Yeah, I think he'll do some bolt-on acquisitions, obviously, and he's doing what they call tuck-ins. So all of the subsidiaries are sort of out there searching in their own vertical to try to acquire businesses and tuck them into their own entities. But I agree, some more international purchases could come around. The most exciting thing for me is seeing him buy back these huge amounts of shares. If he were able to put 100 billion into buybacks, do something private with all of his shares at the Gates Foundation, I don't know what it would be, but that would be a huge catalyst for the shares, for earnings per share. And so I like seeing him put this money into buying back their own stock.
Like just buying more, just doing more buybacks.
If they spent $100 billion on Berkshire Hathaway, I would be thrilled.
Gotcha.
Why are you so boring, Matt? Why are you so boring?
Come on, let's have some fun.
Out of touch and boring. We could invest in GameStop at 110 here and still have upside potential. And you're sitting here saying, I want to buy this boring conglomerate at 8x cash flow and with the 90-something-year-old guys at the helm. But a couple of years from now, who's gonna
yeah, man, we're trying to get views here. Come on, Matt.
The smart financial engineering. Now, what's interesting is, did you see the little conversation between Becky Quick and Elizabeth Warren the other day?
about
so
buybacks,
this is very interesting, right? Yeah, it is.
Yeah.
And I did see it, and thank God we have Buffett, because it is going to be difficult when he's gone. Who is the person who has the credibility to actually talk some sense into politicians who might not know any better? I mean, Elizabeth Warren clearly is off in her own world and doesn't completely even understand the issue. And there's a lot of dishonesty in this argument. But what she's trying to do, right, is convince people who are a little bit closer to the middle. And those people close to the middle have appreciated Buffett's comments in the past. And when someone like Buffett is gone and we don't have that figure and that credibility, there could be some issues there on the political front. And it's something I'd be worried about long term.
So I think in some cases, Elizabeth Warren is correct in terms of like inflating earnings to get a kickback for management through buybacks. But what we're all looking at is these value-based companies that are buying back their shares because they're undervalued. And it just makes so much sense to do that. And it seems to be completely lost on the politicians and the ruling.
I mean, you can't ban it outright. And I think Buffett is saying the same thing. I mean, he's disagreeing, right, with the repurchases that are over fair value. But the result should not be an overall ban, across the board. And that's the problem. And this is what capitalism is, right? You have some people who give all of capitalism a bad name, and it might be a terrible system, but it's the best system out there, right? Mm-hmm. To unleash human ingenuity. And so the solution is not to come top down and ban short selling and ban buybacks and ban, all of these types of things would be horrendous for the economy and for the stock market and for smart people in the stock market, because that's what we're talking about, is these buybacks are extremely intelligent when done correctly. And oftentimes they're not done correctly, but fine. That's great for us to know to avoid those companies as smart investors, so you want to be able to let the market pick winners and losers there and let smart investors decide for themselves. And that's not her argument, of course.
We always look at things for our fund in terms of these three lenses. We're looking for the highest quality managers, the highest quality business models, and then the greatest valuation. And the reason being, if you have a great business model, and Berkshire, of course, is built on this engine of insurance and having float, and it's an excellent business model. If you don't have high quality management, and part of the characteristics of high quality management is being an exceptional capital allocator. And if you lack those skills, which naturally some people lack those skills, you end up with poor capital allocation decisions with the cash flow coming from a great business. So management becomes essential when you're allocating these huge pools of capital. And Buffett's doing buybacks in the right way. And there are obviously other firms where they're destroying value doing buybacks. But it's just another way to look at this and think about the true value available at Berkshire Hathaway with this high quality management and business model selling at this really cheap price.
Very good. Very good. All right, so let's kind of wrap the bow on. I think we pretty much covered everything with regard to this letter. The second part of one of my other questions was, what does this make you now think, in general when you think about 2021? What's some of your thoughts on that based on the letter itself?
Yeah, I mean, so I think you have this dichotomy, right, between the Chamaths of the world and the SPAC world and those people who are interested in financial engineering and an overly hyper aggressive approach. And then you have, obviously, on the far other end, you've got Buffett here, who is aggressive in his own right, but in a safer way. Okay, and to me, I'm cautious about the market as a whole. The economy is, it's still in a difficult situation, and it's not the time here, I think, to be hyper aggressive for the market in general. There's a lot of speculation going on here, and again, to me, this Buffett's approach and Buffett's comments and the focus on the buybacks and not kind of finding real other opportunities in the market at a major size is support in an indicator that now is a time to be kind of cautious as a whole and look more for real opportunities and not just kind of own the S&P, for example. Now's not the time to do that.
Yeah, I have sort of a contrarian view, and I guess I'll preface it by saying, and Steve would agree, that nobody has a crystal ball, and looking at sort of top-down macro factors isn't usually very effective because there's so many exogenous aspects and things. There are unknown unknowns that can pop up, but and I agree with Steve that I think broadly owning an index right now. Now, I'm actually quite bullish, but I think that broadly owning an index, people have to understand that it cannot possibly continue on this trajectory we've had for the last decade. Basically, over the last decade, I think the S&P 500 has returned something like 16% annualized with dividends, which is just astronomical. And if you go and look at Stocks for the Long Run by Jeremy Siegel, and he's done analysis of 200 years of data, you will see very clearly he lays out that decade over decade, very consistently, the markets return about 6.8% plus inflation. And by the way, that's the fastest growing asset class. So, if markets are growing at 6.8 plus inflation and we just had a decade of 16%, I don't think it will drop off necessarily. I actually think there's so much stimulus going on that the market can do quite well this year. But I think people have a tendency to sort of project what they've just experienced. And there's a whole new generation entering the market. Nobody's seen anything like 2009. None of these new folks have seen anything like 2009 or prior crises. And it's just an unsustainable rate of return. So there's been this big push into passive investing. Now, all that said, we run a concentrated portfolio. Steve runs a concentrated portfolio. We're basically looking at bottom up opportunities, and there are a handful of those. In fact, they're right in front of our face, Berkshire Hathaway being one of them. It's not the most exciting company, but it's a core position that we own. I think it's a position that everyone can own. And, but I'll tell you, I apologize for being so long-winded here, but there are a bunch of factors out there that lead me. Again, I don't want to be a talking head talking macro stuff, but I'll just throw out a few of these. I am shocked with all of the stimulus going on right now, and it makes me very optimistic about specific firms. There's some that are overpriced. You can avoid those. You don't need to buy the whole market. But I will tell you, there is something around $4 trillion right now that's sitting in money market accounts earning zero. So a big part of this is the opportunity cost situation that we're in. So interest rates are so low, they're at zero. And if we nobody knows what's going to happen with inflation. There's this whole debate over whether we're going to have inflation or deflation, and there's so much stimulus. I think the objective would be to inflate our way out of some of the COVID debt. So if we do get a little inflation, I expect interest rates to still stay low because of the things and statements Powell has been making. And probably there will be a focus on unemployment numbers rather than on the just pure inflation. So if inflation were to tick up to 3-4%, I don't think that would make Powell move rates, which basically means rates are really low for a really long time. And there's 4 trillion now sitting in money markets. And it was 2 trillion before the pandemic. The whole market, equity market, is like 35 trillion. So there is cash on the sidelines that needs to find a place to go. So when we have things opening up, right? When we have, I think there's a pent up demand, and that kind of money, that stimulus will continue, and that kind of money will flow into the economy, either in terms of direct spending, which inflates the earnings of companies, or direct investing. And the only opportunities, that cash isn't going to go into treasuries. It will go into maybe some real estate and mostly equity positions. So I think we're going to have a bumpy but very nice ride through 2021. And I expect that the markets will finish the year higher.
Yeah, and I don't disagree that there's a strong possibility of that. I think when you talk about where does all this excess cash go to, I think it's going to go into a big garbage can and be lit on fire, essentially. So, yeah,
Through
it can go in the
inflation,
market.
through inflation, is that what you're saying?
Yeah, I mean, yes, I think
Yeah.
there's going to be inflation, and so the place to be is in these hard assets and real estate and things like that. And yeah, I mean, we certainly could see even more of a melt up here through the rest of 2021, and even who knows the timing? It could last a few more years, right? But there, over the next 5 to 7 years, the market is set up, and even 10 years, the market is set up to have significantly lower returns because we have to get back to that average, right? And if there is inflation, we'll see. There is contrarian version or perspectives as well on that, especially from my one of my friends, Keith Smith at the Bonhoeffer Fund. He's got some very lucid arguments as to why there won't be inflation over time. But from my perspective, is that uncertainty should cause concern. And just given the way that the market's acted in the last 15 years, 13 years, 12 years, there will be a lower than average return in the future until we get back to the mean. That's just how it works.
Very good.
Absolutely.
All right. Well, I think that was a great place to end it. So, with that, I mean, is there anything, well, firstly, all right, so we wrapped the bow on Berkshire, our prognostication for 2021. But I have to real quick, Matt, I gotta ask Steve, because on our last episode, him and Thomas Brazil were going back and forth and sharing the case for NTP at Namtai, and they came out with some news yesterday, I think it was. So we got to give the people an update there.
Yeah, happy to share that. So it's great news. It was what we expected for those who are following Namtai. The court decision came down. It was in favor of the activist investors. Now the stock ran up a bit, but now it's kind of come down a little bit today. And the reason is that the reason why I think it's come down is because the NTP, the company itself, said they'll be appealing it. Now, the appeal process in BVI is not really like in the US, and so it will probably end very quickly here. In the meantime, we have a shareholder meeting, a special shareholder meeting for the activists to get their vote happening in April, and that record date for that is March 15th. So what's going to happen here is I think there'll be some forced buying. We're already 10% up from when the result came out yesterday, even after today's drop. But there'll be people buying in ahead of the record date. There'll be ownership, strong ownership and strong interest, knowing that the activist investors in the special meeting will win. And then there's value to be unlocked there at a significant level, significant multiples to today's stock price. So it's a great win, as expected, but good to get the clarity. And the next couple of months are going to be really interesting for Namtai, and it's at in my opinion, a very reasonable valuation. I've got a huge position in it.
All right. Well, we're going to keep this. Now I feel like running a CNBC or something. All right. Well, that active story is ongoing, and we'll keep tabs on that as things develop. So thank you for that correspondence, Steve. But
who are you? Are you Rick Santelli? Are you Becky
no,
Quick?
Are you? No, that I think who's that? I think I said I was Carl Quintanilla last time. I'll keep Carl Quintanilla.
You play it a little bit more straight. You're not Kramer. You're running it a little bit towards the middle. Let the guests be the center stage and shine. There you go.
Hey man, you know my style. That's how it's been going for the last year or so. But with that, Matt, let's get your final thoughts. Going forward. Maybe you want to touch on your letter, or even touch on your letter that you posted. When was that? It was last week. Right?
Yeah, sure. Well, final thoughts. So we did post a letter. It's up on petersonfunds.com just this last week, and it touches on a few of the things that we've discussed here today. And the topics were mostly around Berkshire Hathaway. And I just, I encourage folks to take a good hard look at their portfolio. Berkshire Hathaway probably won't be the best performer in the entire market. But given what we've just explained, that there's going to be this reversion to the mean in the indices where, 6.8% plus inflation is the long run average. And we might have to be below that for a while to basically compensate for all the strong returns we've had in the last decade. Berkshire Hathaway seems just like a beautiful place to park some capital. You just get this compounding effect that I think will last the entire decade. And I'm pretty confident you're going to be outperforming the markets. And when you outperform the markets, you outperform a lot of professionals. So with very little effort, I think you can go out and do quite well if you stick to the bread and butter and some simple companies. And Berkshire Hathaway is right there in front of us all. So I like it. I like this stock.
And if you want to get aggressive, sell puts or buy a.
That's right. I was on it. I wasn't even gonna. I was thinking about not even going there, but that's exactly how we do it, and that's what folks should be doing. They should be writing puts. You can go out a few months or a year and write a put with a 250 strike and pick up a huge amount of premium, and you can take that premium if you want. You can buy some in the money calls and do really well with Berkshire.
Very good. All right. Well, Matt, where can people go and find more information on you and follow you on social media?
Yeah. Petersonfunds.com is our website. Best place to go. There's a lot of information, and you can email me if you want to talk further. And I'm on Twitter as well, so you can find that handle through the website.
Very cool. Steve, final take, and then where people can find you.
I was going to try to show you. I don't know if you can see the horse from here, but he's kind of hiding. So sorry he didn't come out. He was here while we were talking before. You can find me in Puerto Rico. Come to visit. That'd be great. I'll be here for a few more weeks. But other than that, I'm around on Twitter. I'm on Clubhouse. Find me on Clubhouse. Find me and Bobby on Clubhouse.
Yeah, Clubhouse.
You can just search my name, Stephen Kiel, and we can have a conversation there. That's been a fun thing the last few weeks as well. So good to be here and good to see you, Matt.
Yeah, no, Clubhouse is cool. You explained to me offline how I can make it work now. So maybe we'll do one of these on there at some point. And I'm excited to use that platform a little bit more. But gentlemen, it was a pleasure. Again, everybody, you can follow me on Twitter at BobbyK.Crap, BOBBYKKRAFT. You can listen to the Investors Roundtable on our YouTube channel, youtube.com/SNN Wire. Or now we publish it concurrently, the audio version on the Planet MicroCap podcast stream. So go check it out there. Thanks, guys. It was a lot of fun. And, maybe I'll see you guys again next week.
Hopefully
Thank you, Bobby.
All right. Have a great weekend.
See you guys.